Hello, I'm Ted Kirscher with Landrum Human Resources. We want to welcome you to today's webinar. We're going to be covering issues that will impact employers in 2014, including some legal updates as well as the Affordable Care Act. I have with me today Amy Remington, General Counsel at Landrum. Welcome, Amy.
Thanks, Ted.
And Todd Torgeson, the President of Combined Insurance Services. Welcome, Todd.
Thanks, Ted. Glad to be here.
Good, great, glad to have you with us. We'd like to go over with you the items we're going to discuss today so you'll have a sense of what we're going to cover during our webinar. The first, we're going to talk about these employment law updates and what we can expect as we go into 2014. We'll also, of course, move on into 2014 in the Affordable Care Act and what we can expect to find there, including defining exactly what affordable coverage is. We'll move on to tax credits and implications. Of course, the pay versus play question that's on so many people's minds. We'll touch on some of the ongoing debates that we're seeing in Congress, as well as offer some solutions for you. And finally, we'll talk about the Landrum Compliance and Administrative Services that we have for you. Of course, this is intended for your information only, to inform you about the Affordable Care Act, and it's not to be used for legal or tax advice. So Amy, let's move into 2014. January 1st of 2014, there are going to be some changes to minimum wages around the country. So talk to us about the minimum wage changes.
Sure. Let's start with Florida. On January 1st of this upcoming year, the Florida minimum wage will go up. Under the Florida Minimum Wage Act, the Florida Agency for Workforce Innovation has the responsibility of making sure that minimum wage is in keeping with the Consumer Price Index. And where this gets a little complicated for employers is if you're in different states and minimum wage under the federal law is different than under the state law, the higher wage always prevails.
Okay.
In Florida, minimum wage will go up to $7.93 an hour for most employees and $4.91 an hour for tipped employees.
Okay. And then what about the Carolinas?
In the Carolinas and North Carolinas, it will remain at $7.25 an hour for non-tipped employees, which is most employees, and $2.13 an hour for tipped employees. And then in South Carolina, it will also remain at $7.25 for most employees.
Okay. All right, let's move on to the Supreme Court. There's been some really interesting Supreme Court decisions recently. These decisions have impact on employers. So let's talk about the Supreme Court.
Sure. The first one I chose was the National Labor Relations Board versus Noel Canning. And the National Labor Relations Board is a board that's made up of 5 members. And they have jurisdiction over almost every single employer in the United States, whether the employer is unionized or non-unionized. And beginning in 2010 and going through this year, the National Labor Relations Board composition, those 5 members changed a number of times due to natural term endings or people rolling off, new members being selected. And even at one point, between 2010 and 2013, the board only had 2 members. Well, the United States Supreme Court looked at this and said, wait a second, with only 2 members, that's not a quorum. So those decisions, and there were about 550 of them that were issued during the time where there were only 2 employees or 2 members of the board, were not valid. So if you fast forward to 2012 of last year, because there were term limits and things, the board was again reduced to 2 members from 5. And now we know that 3 is a quorum. That's what the Supreme Court said prior to that. So to fill the board, the president appointed 3 new members. And the issue became, were those members valid members? Because they were appointed at a time when the issue was Congress in recess or was Congress in session? If Congress is in recess, the president, under the Recess Appointments Clause, can appoint members. If Congress is in session, you have to have congressional approval. Well, those 3 members stayed on the board, and they continued to act as a united board and issued many decisions, including on a case called Noel Canning. And Noel Canning was an employer. And Noel Canning challenged the authority of the board because they said you have 3 members that aren't really members, so you don't have a quorum, and therefore you can't make a decision that affects us. And that is actually going in front of the Supreme Court this year to determine whether those 3 appointments back in January of 2012 are valid. And the reason that affects all employers is if you have any decision that's pending before the National Labor Relations Board, or you have a decision that's been rendered, it may have been rendered by a board that wasn't a valid board. And it would apply to other federal agencies that had presidential appointments during this time as well.
Gotcha. Wow, what a mess. Let's talk a little bit about the EEOC. You and I have done a lot of presentations around the country talking about background checks and the proper use of background checks for employers, but there was a really interesting case involving the EEOC and background checks.
There was, and boy, have we done some presentations. In 2012, the Equal Employment Opportunity Commission issued a guidance that was very specific that talked about how background checks could be used. Specifically, you had to look at the nature of the job sought and the type of background check you were running and make sure that there was a logical link between those two. And that all makes sense. In this case, the defendant employer ordered background checks for some of its employees, not all of them, and it used very specific criteria. For example, it looked at the position sought and the type of background checks they ran. So if you were looking for a driver position, it might run a motor vehicle check. But if you were looking for a credit position, it might do a credit check. And so they did a very careful analysis, and they only looked back 7 years, and they only looked at conviction records. But the EEOC still filed suit and said that that company engaged in a pattern and practice of discriminating against 3 specific groups: African Americans, Hispanics, and males. And the company responded and said, we have 3 specific goals: to avoid theft, to avoid negligent hiring, and to make sure our entire company is consistent in its hiring practices. So the EEOC's central theme in this case was that background checks should not be used at all because there is this national statistical disparate impact on those 3 groups of people.
Right.
So the EEOC retained an expert, and the expert came back with statistics in support of its position. And the federal court looked at this and said, wait a second, these statistics don't make sense because they're not a cross-section of this type of employer. And the the court even went so far as to say that the EEOC's expert was in fact dishonest. So the court said it dismissed the Title VII case, and in its opinion in doing so, it said that requiring employers to comply with such stringent background check rules placed employers between a rock and a hard place. They could either face potential liability for not doing adequate background checks, or they could incur the wrath of the EEOC. And those are actually the words that the court used. So they're fairly strong words for a court. And interestingly, one of the things I thought was the most interesting came in a footnote, and the footnote admonished the EEOC when it said the EEOC itself runs background checks on 100% of its new hires and credit checks on 90% of its new hires, regardless of position.
What great irony there.
Right.
Huh?
So
yeah, that's great. Well, another case that got a lot of attention this past year was the Defense of Marriage Act. Certainly it has impacts on us as a society, but then it certainly has important impacts on employers as well.
It sure does. And to review, the Defense of Marriage Act was a federal law that was passed in 1996, and it contained very specific definitions. For example, marriage is defined in the Act as a relationship between a man and a woman, one man, one woman. And spouse is defined as somebody of the opposite sex. So it does not recognize any relationship outside of those specific definitions. Well, then we fast forward to today in a case called U.S. v. Windsor. And what happened in this case I thought was very, very interesting. Ms. Windsor and Thea Spire were 2 women who were in a relationship for 40 plus years. They began their relationship in 1965. And in fact, in 2007, they went to Canada and were legally married in Canada and then returned to their home state of New York. 2 years later, Ms. Spire passed away, and she left her entire estate to Ms. Windsor. And if they had been an opposite sex, traditionally married couple, Ms. Windsor would have received an income estate exemption where she would have retained almost $400,000, $363,000 in estate taxes. But because they were opposite sex couples, she had to pay that amount in estate taxes. So she filed a lawsuit under the Defense of Marriage Act, arguing that Section 3 limited her right under the Due Process Clause of the Fifth Amendment to the Constitution. And this year, the matter went all the way to the Supreme Court, and in a 5-4 decision, the court said that Section 3, which again only takes that definition of marriage and spouse, that definition in and of itself was unconstitutional because it denied her due process rights that are guaranteed to every citizen.
Involved in a same-sex relationship is what really what was at the heart of the issue.
Absolutely. That's what the heart of the issue was.
Right. Well, that has impacts on other federal acts like the Family Medical Leave Act, right?
Absolutely. It's interesting because if you look at different states have different definitions now. And even within the federal government, even though there's no overarching definition of spouse or marriage, different laws affect it different ways. For example, under the Family Medical Leave Act, spouse is defined by the state law where the employee resides. Now, if you're an employer and you have many locations throughout the United States, or you have traveling employees, or you have telecommuting employees, where the employee resides is what you look at to determine, do they have coverage under the Family and Medical Leave Act? But under the immigration law, the United States Citizens and Immigration Services looks at where the marriage took place to determine if it's a valid marriage. So employers may want to consider this when they're considering requests under the Family and Medical Leave Act, or how to handle an immigration issue, things like that. And the other thing is, employers should look at their benefit policies and see how the states where their employees are working are trending.
Well, speaking of the states, really much like the Affordable Care Act, what's happening at the states and it's changing all around the country is having an impact on this issue as well. We've got a graph, I think, that shows you what's happening at the state level.
Absolutely. And the interesting thing about this graph to me is we prepared this just a week ago, and since then, this graph has changed. This is a graph that shows states where same-sex marriage is performed and recognized currently. But when we prepared this, Illinois and Hawaii weren't on this graph. But as recently as 2 days ago, those states became states numbers 16 and 17. And then the next graph shows states where same-sex marriage legalization efforts are underway. And so it is definitely a trend that employers, especially employers with employees that telecommute or that are in different states, or you have one home office and many branch offices, that employers really need to know what the trend is in that state and what the law says in that state.
Great. Well, we've got some resources for you. If you'd like to take a look at our blog, landrumhrblog.com, we keep current information about these issues up on our blog, so you can get a chance to really see the current information about some of the legal issues Amy's talked about, and as well as what's happening with the Affordable Care Act. So that's landrumhrblog.com. Also, I would invite your questions. If you'd like to email questions to us at questions@landrumhr.com, we'll review those questions at the end of our webinar. Todd, let's move on to the Affordable Care Act and talk about what's happening in 2014. There's so many things have changed, so many things are happening out there. Maybe we ought to start with what's not included.
Well, this is just December 3rd, so we have to keep that in mind, that there's been a lot of changes just as late as last week.
Right.
So going forward, we have to make that caveat that there's going to be more changes probably coming.
Yeah, absolutely.
But the big one, of course, is that the mandate, the large group mandate to provide insurance, has been delayed until 2015. So
Right.
that's a relief for a lot of employers out there.
Not time to be complacent. There are some things to do, and we'll talk about that a little bit later. But
everyone needs to be prepared, regardless.
But, absolutely right.
Yeah.
Well, let's talk about the actual the policies themselves. There are going to be some changes to the policies themselves, the coverage available.
That's right. And what we do know, we've had these changes coming into place already, but what we do know is that coverage now will be guaranteed issue. Anybody can get it that wants it, and it'll be with no pre-existing condition limitations. So regardless of what your medical history is, regardless of what you have going into the plan, you'll be able to get the plan and you'll be able to use it right away.
Great. Well, a lot of talk about exchanges, and I think maybe what some people don't realize is that really we're actually talking about two different ways to acquire health insurance through these exchanges. So let's talk about the exchanges.
Yeah, well, keep in mind the exchange is supposed to be a virtual marketplace. And the two kinds of exchanges that are out there, first is the marketplace, and that's what you see on TV and here on the news is healthcare.gov. That's really what that's about.
Right.
And that is designed for individuals that need insurance. And then the other exchange is the shop exchange. That's for small groups. And that's one of the areas we'll talk about a little bit more later, but there's been some pretty dramatic changes over the past week on that as well.
Yeah, they sure have. Well, there's an important distinction about the exchanges for individuals, and that's the issue of subsidies.
Right. Yeah, subsidies are available only for individuals, Ted. So if you're on a group plan, don't count on a subsidy there. And the only way to get a subsidy, if you qualify otherwise, is through the marketplace exchange.
Gotcha. Well, one thing that hasn't changed and that is the requirement that basically all Americans have health insurance coverage. That's going to take effect January 1st of 2014.
That's right. That part of the law is still in existence. It's under fire, but it's still in existence. And you're right. What it's saying is that the vast majority of people in this country are going to either have to be provided insurance, or they're going to have to get it on their own or pay a fine. And that means pretty much all of us, except those that are in certain accepted categories, like whether you're incarcerated or if you're a member of a certain religious sect. And that's not Catholic or Baptist. That's not a mainstream religious sect that gets the exemption.
Right, right. Well, there is a penalty associated with not getting this coverage, and I think there's been some misunderstanding about that penalty.
There's been a lot of misunderstanding. There's been a lot of political rhetoric around it as well, because what makes the news is the $95 penalty. What doesn't make the news is the fact that it's the greater of $95 or 1% of your household income.
Right.
And that's per affected household member. So if you have, say, 2 people in the family and together you make $70,000, well, that's a $700 penalty that you as a family would have to pay.
Right. So it's important to keep that in mind, maybe not as lightly as some people might have thought.
And these penalties are going to grow as the years go by.
That's exactly right, yeah. Another change that we've seen recently is the enrollment date and what it takes to actually exempt you from the penalty.
Right. That's been somewhat of a moving target, but where we are right now is that as long as you sign up by March 31st, your effective date doesn't have to be March 31st, but as long as you sign up by then, you're going to be good to go.
Okay. Let's talk about policy changes. I mean, the policy itself that individual might get. There are some changes, again, that will go into effect on January 1st.
Right. The law requires certain benefit standards, and that's what we're going to be talking about next, are some of the standards that have to be included in new plans. But keep in mind, as of last week, I think the world saw that President Obama allowed the insurance companies to make an exception and keep the existing plans on the books for another year, regardless of whether they meet these new standards.
Gotcha.
Then the insurance companies had to decide amongst themselves whether it would be feasible for them to actually continue these plans. And there's a lot of logistical and regulatory issues that go into releasing plans like this.
Right.
So what we do know here is, at least in Florida, and it could vary in North Carolina and South Carolina, but at least here in Florida, Florida Blue and United Healthcare and their major competitors have all said, yes, we're going to do this. Now, it's going to be kind of a mess administratively, but I think it's going to provide some relief for a lot of these employers. And
certainly that's an area that we can help our clients with, in the various states, and let them know exactly what the impact is going to be in their state.
But the plan design, like it was up on the screen there about ambulance service, what we're going to see there is that typically it's been a $5,000 or $5,500 a day maximum. That will have to go away. And just like most other benefits associated with this act, that's all good on the user or consumer end, but we're going to see a price to pay in the premiums.
Right, exactly right. Exactly right. Well, sticking on the theme, I guess, of these, I guess we'll call them ACA compliant plans, there's some changes about cost sharing.
That's right, that's right. And what we're talking about here, Ted, is the out-of-pocket maximum. That's the point at which the insurance company starts paying at 100% of covered expenses. And that's to protect people from cost sharing that goes up into the hundreds of thousands of dollars and provides kind of a stopgap for folks. And for plans that are non-grandfathered or non-renewed, if you're on your existing plan, if it's non-renewed going forward in 2014, that benefit out-of-pocket maximum is going to be $6,350. And that's important because we've got a lot of plans on the books today. In fact, a couple with our Landrum plan that have an out-of-pocket maximum of $10,000, and there's some out there at $15,000 or $25,000. So again, better benefits, increased price.
Right. Well, something else that's changed that it really impacts the pricing of these plans, and that's the rating rules that are used to price these plans.
That's right. And you and I have been discussing this, I guess, for over 3 years now on these webinars and other seminars, and we're just now starting to see the effects of this play out in our business for small renewals, and this is really what it affects. And when you look at this next slide here, where we talk about the 1-to-3 ratio, what we're really saying here is that it's transitioning from the insurance companies producing rates that baked in an assumption that the most risky employee, oldest, less healthy, would cost, say, 10 times as much as the least risky employee. Now that's going to be collapsed to a 1-to-3 ratio. So what that means is that we're going to have more of an average rate, more of a community rate. And like in anything else, when you average things, you're going to have some winners and some losers.
Right.
The losers in this situation are going to be those on the younger end of the age spectrum because they're going to be drawn up toward the middle.
Right.
The winners will be the rest of us.
Right. Well, there are some things that, continuing on with the rating rule conversation, there are some things that you can't consider, the insurance companies can't consider when setting these rates.
That's right. When you look at that, and again, it's a continuation of the same theme, where gender will now be neutralized. The way rate rules have worked historically, they've looked at the experience of gender, and the males, young males, were less expensive till we get in our 50s, and then the females start to become less expensive than men. But that'll be neutralized going forward. And depending on the makeup of your group, if you have a large population mix one way or the other, that's going to have a pretty remarkable impact on your small group rates. But again, no medical history will be taken into account, and there'll be no medical conditions taken into account.
So what can you look at in setting these rates? What can an insurance company look at in setting these rates?
Well, age is one, and we all know it's still better to be young than to be old, and that's still true with health insurance going forward. But the family size will now be taken into account, where historically you might have, say, a family of 5 people, spouse and 3 kids, and you'd have a rate, say $1,500 for that plan. Well, now the rate buildup is going to be based on the age and sex, or the age rather, not gender, but the age of that employee, the age of the spouse, and then the number of children.
Okay.
So with a maximum of 3. So there's going to be a lot more variation, a lot more cumbersome rating going forward than in the past. There'll be no more composite rating for these small groups. It's going to be table rated, which in terms of payroll deductions and billing and things like that, trying to understand what your costs are, a lot more difficult than it has been in the past. And that's one of the reasons why the Landrum Master Plan that we have is going to be a good place to be for these smaller employers, because we're not subject to these same rating rules that we talked about, the 1-to-3 ratio, and we're certainly not subject to the table rating rules that are going into place.
Well, one of my favorite parts of the law is this prohibition of excessive waiting period. So when I go to the doctor now, it's going to limit the time I can spend waiting for the doctor, right?
You do have wishful thinking, don't you? Actually, what we're talking about here is the eligibility period for which an employee has to wait before they're eligible to come onto the plan.
Gotcha.
And the new rule is that it's a maximum of 90 days. Now, where this is going to catch a lot of employers is that the current standard for that for employers is, say, a first of the month after 90 days of employment. And that's helpful administratively to do it that way versus trying to handpick the day of the month that the new employee should come on board.
Right.
That gets pretty cumbersome.
Right.
But that's what we're going to see now is first of the month after 60 days will be the longest time period that you'll be able to do, or the 90th day.
Gotcha. Okay.
So when we look at our own Landrum plan here, we've already concluded that we're going to move to first of the month after 60 days.
Right. Well, let's talk about go back to the issue of affordability for a minute and talk about exactly who does that impact.
Well, it affects individuals and it affects employers, although it's going to be in different ways. When we look at individuals, what we're seeing there is that that's really going to help us determine whether or not they're eligible for a subsidy. That's the primary issue here.
Right.
When we look at groups, and we look at, and again, we're talking about large employers that have over 50 full-time equivalents, it's going to be, and in 2015 again, that's going to be a key determinant as to whether that employer is subject to a shared responsibility fine.
Right. And let's emphasize this point that we're talking about large employers, those that have 50 or more full-time equivalents. That's who really has the major impact on the shared responsibility, on the pay or play, all that. It's for those large employers, and again, our definition of large here in the law is 50 or more full-time equivalent employees.
Exactly. And I'm glad you brought that up, because we still get questions every week from smaller employers that say maybe have 10 or 15 employees, and they say, when are we going to be subject to this fine if we don't provide insurance?
Right.
And that's just not the case.
Right.
The way the law is written today, it's only for the large, like you mentioned.
Right. So we've talked about there's an affordability question as it relates to these plans, and then there's a value question associated with these plans.
That's right. All of your metallic plans going forward for small group and individual have to meet certain standards, and for an employer to avoid penalty if they're large, their plan has to meet what they call a minimum value standard. And all they're saying there is that the plan must have an actuarial value of 60%, which means that the plan overall, it wouldn't, maybe for you or maybe not for Amy, but for all of us overall, would cover 60% of our medical expenses.
Gotcha. Okay. Well, for the affordability piece, there's kind of a threshold for that, an area that impacts on the affordability side. So let's talk about that.
That's right. And what they're saying there is that the plan doesn't meet affordability. It's not meeting the 60% actuarial value. That's one of the two tests. We're going to get to the pricing test here in a moment.
Right.
But on the next slide here, we have an example of what one of the bronze plans looks like, and it's a $6,250 deductible with 100% coinsurance after that. So it's not as if these benefits are super rich plans that meet muster. There's still a lot of room for employers to go with plans.
Okay, so that's the value side of the equation.
That's
now
right.
Let's talk about let's go back to the affordable side of the equation.
That's right. Now we're talking about the financial thresholds associated with that. And for the individuals, it's going to be 9.5% of their household income. And for employers, they will be able to use household income, but how are they going to obtain that?
Yeah, boy.
I mean, that's really a nut I haven't found anyone able to crack really yet. So the government recognized that, and they put together some safe harbors to help employers meet that obligation. And one that we think is going to be the most popular is what they call the W-2 safe harbor, where they'll just use the employee's W-2.
Right.
Lowers the threshold for affordability, but it's the only way that the employers really, I think, can keep up with things.
Which leads to an issue about a family glitch. And I guess we're not talking Thanksgiving dinner kind of glitches here, are we? We're talking to some other issues with the family.
I guess it could be both. It depends who you ask. But this family glitch is a real thing, and it's surprising a lot of people. And when we look at the next slide here, we'll see that what it means is that if you're employed and your employer provides you minimum value coverage and it's affordable,
Right.
then you're not eligible for a subsidy, nor is your spouse, nor are your dependent children. That's why they call it the family glitch, because that's unrelated to whatever your income level is.
Right.
You can have income just above the Medicaid threshold and still not be eligible for subsidy because your employer is providing that coverage. There is one little bit of good news, though, and that is that if you fall in that category and the cost of coverage is more than 8% of your family household income, then at least you don't have to pay a fine. But that's the thing. We had one of our Landrum clients call today. The employee was looking for his subsidy online and couldn't figure it out. And I said, that's because you're not eligible. Your employer is taking care of you here. He can still get coverage for his spouse and kids off exchange.
Right.
Same guaranteed issue, same no pre-existing conditions.
Right. Well, yeah. So we're talking. You mentioned the exchange. Let's shift over to the shop exchange.
Right.
Sort of sounds good theoretically, but I think in practice we're seeing some real limitations around the shop exchange.
Well, we certainly are for 2014, because that's part of the big news that we have. Is the shop exchange, as indicated earlier, is really for the small groups. Supposed to be a virtual marketplace for them to go and compare, and employees pick different plans. And they've hit some logistical bumps along the way, and so ultimately announced last week, the shop exchange is going to be delayed for an entire year. So it's predicted to go into place in November of 2014, next year.
So there are limitations there.
Oh yeah, there will be, and part of the game plan, or part of the issue here, at least in Florida, and it varies state by state when we looked in North Carolina and South Carolina, but in Florida there are several counties throughout the state where only one insurance company is actually participating.
So limited competition.
Exactly.
Yep.
Exactly.
Yep. And limited plan options as well.
Well, that was part of the problem too in 2014. If they had gotten it off the ground, there was only going to be one plan per employer available. So it really didn't meet the definition of what they were attempting to accomplish with the shop exchange. So I think it was probably a better thing to go ahead and back out of it this time around, because they have other means to get their group insurance just in the traditional fashion.
Right. Another area of confusion, and I think probably a relatively wide misunderstanding, is the small business tax credit. That has a shop implication to it as well.
Well, that's right, because the shop was going to be the sole source to be able to attain tax credits, and we'll talk about what they are and have some examples here shortly. But you have to keep in mind first is that the SHOP, or the tax credit rather, is not going to be a panacea. And
Right.
we've got the examples to show
Yeah,
that.
exactly.
And it's going to be somewhat cumbersome. Now, going forward in 2014, because the only place you could have gotten the tax credit was going to be through the SHOP exchange, what the government said now, and we're still waiting to get the regulations out and make sure we know exactly how to implement, is that if the employer purchases a qualified plan going forward, so it's not one of the old plans that you can now keep,
Right, one of our
even though it
compliant
doesn't meet the
plans.
standards, it's
Right.
got to be one of the new compliant ones.
Right,
That's
right.
right.
Yeah. Well, it is a pretty narrow standard by which to get this tax credit.
It is really, and it's, you think of it as a sliding scale. It's really designed for employers that have 25 and fewer employees, and with a wage base of averaging less than $50,000.
Right.
And where most of the tax credit is, where you'll find it, is when you get below, say, 15 or so employees, and down below $25,000 in wages. And keep in mind, too, an important factor as we start to look at these examples next, is that you cannot double deduct. In other words, you can't get the tax credit and take a tax deduction for the premiums you pay. So it kind of balances out in a lot of situations.
Right. Well, let's talk about that. We've got some, I think the key word you used there, key phrase you used was the sliding scale, because that really, the examples we're going to show, I think really emphasize the impact that sliding scale has on that. Let's talk about this one here with just 8 employees.
Right. This is one that our Landrum finance area worked up for us, and we just took an average salary of $20,000. The employer's paying 50% of the single cost. Subsidy $7,200. So that's not so bad. And then we go to the next one here, where we're looking at a 15 employee population, and the average salary goes up to $25,000, and the tax credit there is just a shade over $9,000. Then when we look at the next one here, where we have, say, 22 employees with an average salary of $45,000, our calculations actually came to no tax credit.
No credit at all.
Yeah,
Right.
and so it'd been much better off to take the tax deduction.
Right, exactly.
Yeah, and you have a lot more flexibility in terms of the type benefit plans you choose and where you choose them.
I would remind you about your questions. If you'd like to send us questions, it's questions@landrumhr.com, and we'll answer your questions at the end of the webinar here. Todd, pay versus play. We've heard that bandied about a lot over the last 3 years. Let's remind people again exactly what that means.
Well, essentially what we're saying here is that the employer that is a large employer is going to have to make a decision that they're going to participate in this and purchase insurance for their employees and make it affordable. If they're not, they're going to pay.
Right.
And that's pretty much it. And
Right.
again, as we look at the next slide here, that has been delayed until 2015.
Right.
So all the large employers are off the hook for this year, and then we'll see how things play out going next year. But it doesn't mean you want to be caught unprepared.
Exactly right.
I'm especially thankful that this delay did go into place, because I know there are a lot of employers that really didn't think it through as well as they should have, or get the help that they should have gotten.
Right.
And they would have gone into 14 a little behind the game.
Absolutely, no doubt
Yeah.
about it. But again, this applies to large groups.
Right.
We're talking 50 or more, 51 or more full-time equivalent employees.
That's right. And there's a formula to work through, and we have the tools available to employers to help them make sure whether or not they meet that guideline. Because we're not talking about full-time employees. We're talking about full-time equivalents.
Right.
So the number of part-time hours that you accrue builds up toward that full-time equivalency status.
Right. It's a difficult calculation in some respects. If you've got PRN employees or part-time employees or seasonal employees or employees who come and go, all those things impact the calculations, and it's very, very difficult to do without software, which Landrum has software that will take information out of our payroll system and then be able to help employers make those kind of decisions.
Right, right.
Yeah, very, very important. So what does trigger the penalty?
Well, that's another area of confusion, and I think everybody needs to be clear on that. And in fact, we kind of added to that when we said you either have to purchase insurance for your employees or pay a penalty. The real trigger is not whether or not you purchase insurance for the employee, it's whether the employee goes to the exchange and is subsidy eligible and purchases insurance that way.
Gotcha.
That's what triggers the penalty.
Gotcha. And then there are a couple of different types of penalties. There's one that relates to just not providing coverage at all.
That's right. That's technically referred to as the sledgehammer penalty. What that's saying is that there's a $2,000 penalty for every single employee, regardless of whether they take the insurance. But every employee, there's a $2,000 penalty, minus the first 30 employees.
Right. But then if you offer coverage out there, now you get into the issue of is it affordable and is it adequate?
So yeah, in other words, you're providing an insurance plan, it doesn't meet the standards or it doesn't meet the affordability thresholds. That's what we call the insult to injury penalty, because you've gone to the effort to provide the coverage and make it available and the expense, and you're still stuck with a penalty. And this penalty is $3,000 per affected individual for each individual that goes on the exchange. But there would never be more in total than if you didn't purchase insurance at all. So it's the lesser of on those two penalties.
And then there's a tax question related to these penalties.
Oh, absolutely, and that's one of the biggest deals of all when the employer works through the math of all this. And we've got some examples coming up, but this is not tax deductible, the $2,000. So the revenue you have to generate to create the $2,000 is much greater than the $2,000 penalty that you see.
Right. Well, let's talk. We've got an example here that involves 60 full-time employees. Let's walk through that example.
That's right. The first slide here, we see that we've got 60 full-timers, 45 are covered, and the employer contribution towards insurance is $215 per employee per month.
So that gives us a total cost?
That's right. The total cost, you look at the next slide here, is $116,000 for the employer. The corporate tax rate, 35%, which is pretty routine, which means that there's a tax deduction of $40,000, leaving the after-tax actual cost of $75,000. Okay, so that's the real net cost of the benefits to the employer.
Exactly. Now let's talk about what happens if that employer chose not to offer coverage.
If you choose door number 2 and go with the penalty, you see here that you've got and we chose, just for the viewers here, we chose a relatively small employer.
Right.
We took 60 lives, so you take out the first 30, leaving a $60,000 penalty. You've got a tax rate again of 35%. The additional tax loss is $21,000, making the net penalty $81,000. So when you sum it all up and you look at the two things, and like on this next slide here, we'll show the bottom line. The to play or not to play comes a lot clearer into focus. It's not just a slam dunk that, well, I'm going to pay the $2,000 penalty.
Right.
Because in this example, which is not far-fetched at all,
right,
the penalty is actually greater than the cost of doing the insurance.
Right. And that's just on just that piece of it alone. Then you start talking about the impact on talent. Most employers that offer insurance today do it because they think it's an important part of their talent attraction and retention strategy, and so you have that to consider. It's like our earlier question, really. These are complex issues that you just have to look at the problem holistically to decide what's really in your best interest as an employer.
That's right, and you're really striking at the heart or in the origin of employee benefits, which really took off after World War II, which was to attract and retain the kind of people you need to be successful.
Right, exactly right. Well, let's move on and talk about Congress for a little bit. There's a lot of, we've talked about all these changes that have happened so far, and there's certainly the possibility of some more changes based on what's going on in Congress.
I guess they're going back and forth a little bit here and
perhaps,
there.
Perhaps.
Right. Well, there's some key things that are still up for grabs, and there may be others. And based on the last couple of weeks, a lot of this is unpredictable. But what we do know is that there's discussions about delaying the individual mandate, which would have a lot of issues associated with that going forward, because that was the quid pro quo for the insurance companies to provide guaranteed issue coverage with no pre-existing limitations. And then also, which could be helpful to a lot of employers, the large ones, when they're trying to determine whether they want to play or pay, is to raise the threshold for what makes a full-time employee. So instead of 30 hours, it might be 35 or 40 hours would be the threshold there.
Yeah, that's important that we point that out about for these large employers. It is 30 hours is the threshold for providing benefits, not 40 that we're traditionally accustomed to.
Exactly.
Yeah.
Exactly.
Yeah.
And then there's a lot of discussion, I don't know how far along we'll get, but is a full repeal, which would, at this stage of the game, with a lot of people already signed up for guaranteed issue coverage, it's somewhat impractical to fully repeal it.
Right.
without some stipulations on taking care of people that have already crossed the bridge, so to speak.
Right. Well, let's talk about some solutions. We do have some solutions for folks, some ways to help them, work through this issue. Let's talk first, Todd, about small employers and how do you model this?
Right. Well, employers definitely need to get engaged. I know benefits, especially health insurance, is not an exciting or fun subject, but it is expensive and it is important to employees. All the statistics, all the surveys show that employees value their group benefits that their employer provides. But one thing we would suggest is for the micro smalls, the groups of say less than 5 or less than 4, something like that, really take a hard look at just converting to individual coverage rather than attempting to keep up with the demands of a group plan. There may be some opportunity for those employers.
But again, it's all very employer specific.
Exactly.
It's not the same answer for every employer out there.
There's no tax advantage for employers, or for that matter employees, when they pay for the individual coverage. So for the larger, even the larger small groups, it doesn't make a lot of sense at all.
Right.
But for the real small groups, you don't have to worry about then meeting participation rules and things. So it could be helpful.
Right. What about dependent coverage?
Well, that is an opportunity for some employers, or employees rather, is to explore whether or not this new guaranteed issue coverage, that no pre-existing, if that would fill their need better than doing a payroll deducted plan at work. So it just depends, again, how many kids you have and how old you are, those kind of things that'll go into the mix. But it'll vary by person, vary by plan, really will.
Yeah, another prudent thing to do is to do like we just did a little second ago here with our examples, and that is kind of model the tax implications of all this.
Oh, sure, yeah. I mean, this is, for your tax deductibility, that's a major issue. And then for the large employers, I think it's equally or more important, even though this law has been delayed, that they need to start modeling this out right now and make sure that they've got the products in place, they've got the contributions in place, and that they know who they want to cover.
Yeah.
And that they make preparations for those that they're not going to cover, so that they don't get fined.
Right. Which kind of moves on to our next slide about the methodology for counting hours. That's where, as I've told a number of groups, this really is not a spreadsheet exercise. With the rules about part-time employees, about PRN employees, about seasonal employees, about those employees that sort of come and go, have long breaks in service, it's very, very difficult to be able to track those employees and exactly see who the law applies to and who it doesn't. And so Landrum has purchased software that will allow us to provide management reports for our clients. We'll be taking that information directly out of our payroll system and then be able to go back and sit down with our clients and work through the issue with them and show them on this pay or play question exactly who's impacted by it.
That's exactly right. You want to make sure you're aligned with the folks that have the tools and the resources to make sure you're making the right decisions for you and your company.
And that's where I think our role at Landrum comes into play. We're there to help with the administrative and compliance burdens associated with this law. That's always really been our main value to our clients, is to help them with compliance, but to help them develop a strategy for their benefits, to help them understand what and really ease their administrative burdens and their compliance burden. That's a major piece that we've always done for our clients, and this becomes even more important, I think, under the Affordable Care Act.
Yeah, there's no doubt about that.
We also, to talk about our compliance questions, the W-2 reporting, there are some important changes with W-2s. We're able to assist our clients and have already begun to do that. We did that this year for our clients in terms of reporting the cost of benefits to those that required it. The summary of benefits and coverages that every employer has to provide to their employees. We're taking care of that for them, for our clients. The exchange notices that went out October 1st, and it's now required for every new employee within 14 days of hire. That's another benefit that we take care of for our employees. For the last number of years, the Medicare Part D notice has been another service that Landrum has provided to our clients. COBRA administration has always been out there and something that we do. And we're going to be offering compliant plans. We've talked a little bit about what these plans look like. That's our responsibility, is to help stay on top of those plans and offer them that, as well as the composite rating that we've talked some about those banded rates and all, and being able to offer a composite rate is very important. I've talked about the tools that we've got with these variable hour employees. I just can't emphasize enough how critical that is, and that we'll do that for our clients, as well as to help them determine what their penalty status might be, and kind of walk them through the pay or play calculations. I mentioned we do have some resources out there. We've got a book available that's just recently been updated that you can buy at Amazon. It's available both in paperback and in the Kindle version. It's really an up-to-date resource as of a couple of weeks ago, really. We also have our blog, the landrumhrblog.com, that you can go to for up-to-date information about all these issues that we've talked about this afternoon. We have a few questions that have been emailed into us, so let's dive into those in our remaining few minutes here. What's the best way for employees to find out exactly what their choices are in the exchange?
That came from my office, actually. I think really the best way to do that is to get in touch with an agency that does this kind of business.
Right.
And that's the best way to do it, because the insurance agencies like ours have the ability to place products on and off the exchange. Mm-hmm. The rate's the same whether you use an agent or not. So
right.
If you're interested in that individual exchange coverage, there's no doubt that's the right way to go. You get expert help, licensed, and all that.
Exactly right. Okay, our next question. Is there a list of criteria that an individual must meet to get coverage in the marketplace? For coverage, there isn't necessarily a requirement for coverage. There would be if you're talking about a subsidy.
Exactly.
But for the coverage question,
right.
That's pretty much any American that chooses to purchase through the
Exactly.
marketplace.
Yeah, anyone that falls into the American category can buy the coverage.
Right.
It's
but
just
the subsidy is what has
right.
the requirements on there.
That's right.
Which private health insurance providers will still be available to employees if they do not qualify for coverage through the marketplace? I think, again, maybe we're confusing coverage with subsidy.
Well, it could be that they're talking about off exchange here, and if that's the case, then I would go back to the earlier slide we talked about, that there's actually somewhat limited competition in the exchange.
Right.
There's going to be more competition, as it stands today at least, outside of the exchange.
Right.
In most areas.
But again, most people would be, if they wanted to purchase coverage through the exchange, they could.
Oh, sure.
Yeah. I mean,
but just depending on the different companies
exactly.
that they want. Yeah.
Exactly right. Limited choices, but still
That's right.
available. Yeah. We have fewer than 25 employees. Do we have to provide health insurance? And the answer is no. This is back to the large employer question. Again, doesn't kick into 2015 anyway, but it's 50 full-time equivalent or more is really what.
Yeah, and just to clarify, even if you're a large employer, you don't have to buy the insurance.
You don't have to buy it. That's right.
There could be a fine if your employees are eligible for subsidy.
Right.
So if you have every one of your employees that makes $150,000 a year, it's going to be hard for anybody there to qualify for a subsidy.
Right.
You don't have to buy coverage and there'll be no penalty.
Exactly
It's
right.
an unusual example for most of our areas,
Yeah,
but
exactly.
that's how it could work.
Good point.
If we do provide health insurance, what number of hours per week do they have to work for us to be required to pay for health insurance? Well, 30 hours a week would be the simplest definition or
That's the threshold.
simplest answer to
Yeah.
that particular question. Again, you're not required to pay.
To stay out of the penalty box.
Right, exactly.
That's right.
Not required to, for 30 hours. How will healthcare reform affect taxes on businesses with fewer than 50 employees and businesses with more than 50 employees? I think hopefully our examples from earlier in the webinar really address that question. The tax deductibility of your contribution toward those policies hasn't changed any.
That's
so
right.
whether you're above 50, below 50, that part hasn't changed. It's really the impact of the penalties on those large employers is really probably the major significant tax change.
Right. The tax deductibility of benefits, particularly health insurance, is always something that gets bandied around.
Right.
But historically and today, it's still tax deductible.
Right. And finally, our last question is, will this webinar be available for online viewing also? Absolutely. We have a YouTube channel. If you go to youtube.com/Landrum Companies, you can see all of our webinars that we've done in the past, and we'll have this one archived by the end of the week on YouTube. So again, I want to thank you for tuning in. I want to thank my co-presenters, Amy Remington and Todd Torgerson. Thanks for being with us today.
Thank you, Ted.
And invite you, if you have other questions for us, feel free to send them to questions@landrumhr.com. And if you'd like to schedule a time for us to come out and meet with you individually and talk about the impact that this has on your business, be sure and contact us through that questions@landrumhr.com. And we thank you for joining us today.